Welcome to Simply Explained Academy. If you've already dipped your toes into the world of crypto and understand the basics, things like Bitcoin, Ethereum, and how blockchains work, then congratulations, you're no longer a beginner. But that also means it's time to level up. Today, we're diving into 10 crypto terms every intermediate user should know. These are the concepts you'll see everywhere, in Twitter threads, Discord servers, and news articles. So if you want to sound like you know what you're talking about, stick around. All right, first up, smart contracts. Don't let the name scare you. It's really just code that lives on a blockchain and automatically runs when predefined conditions are met. Imagine a vending machine. You insert cash, select your snack, and boom, the machine dispenses it. No cashier needed. On blockchains like Ethereum or Solana, smart contracts act as vending machines for all sorts of decentralized apps, DeFi platforms, NFT marketplaces, or even decentralized games. They remove middlemen, reduce costs, and make transactions transparent. When you hear someone say, the protocol is locked by a smart contract, now you know they mean that the rules are enforced by code, not by people. Next term, DeFi, which stands for decentralized finance, basically banking without banks. Instead of a bank, you connect your crypto wallet to apps like Uniswap or Compound. Want to earn interest? Just deposit your tokens. Need a loan? Lock up some crypto as collateral and borrow. It all runs on automated code, smart contracts, so there's no middleman. Just remember, DeFi can be risky. Software bugs or hacks have drained funds before. But when it works, you can earn returns you won't get at a regular bank. Understanding DeFi is key if you want to grow and use your crypto. Moving on to liquidity pools, which are like shared piggy banks for DeFi. Imagine you and a friend each put in the same amount of two different coins, let's say ETH and USDC, into one big pot. That pot lives inside a smart contract on a platform like Uniswap. When you swap ETH for USDC, you trade directly with that pot instead of another person. Why do people add their coins? They become liquidity providers and earn a tiny cut of every trade that happens in that pool. It's an easy way to make passive income. One thing to watch out for is called impermanent loss. If the price of ETH or USDC moves a lot, you might end up with less value in your pot than if you just held your coins separately. The smart contract uses an automatic formula to keep prices balanced, but big swings can shave off some of your gains. Liquidity pools are the backbone of decentralized exchanges, yield farms, and even on-chain lending. Even as a beginner, knowing this setup helps you understand how DeFi works and where you can earn rewards or run into risks. All right, let's break down a term that sounds super complicated but really isn't: tokenomics. It's just a mashup of token and economics. Basically, it's all about how a crypto token is set up, like how many tokens exist, who gets them, when they're released, and how they're used over time. Good tokenomics means everyone, developers, investors, and users, has something to gain over time. It keeps the project healthy and growing. But bad tokenomics, that's when a few people hold a massive chunk of tokens from the start, or when too many tokens get released too quickly. That can crash the price and destroy trust in the project. So, when you look into a new crypto, check the white paper. That's like the project's blueprint. See who owns the tokens, how they're being released, and whether there are any plans to reduce supply over time. If you understand the tokenomics, you're way less likely to fall for a bad project. All right, let's talk about stablecoins. They're kind of like crypto's version of cash. These are digital tokens that are designed to stay equal in value to something stable, usually the US dollar. So one stablecoin is meant to always be worth about $1. You've probably heard of USDT and USDC. Those are the two biggest stablecoins. People use them when they want to take a break from price swings without completely leaving the crypto world. Let's say the market's going crazy and you don't want to lose value. You can swap your Bitcoin or Ethereum for a stablecoin and just chill until things calm down. You can also use stablecoins in DeFi apps to earn rewards or interest. And because they don't move up and down like other coins, it's easier to plan your strategy. But, and this is important, not all stablecoins work the same way. For example, USDC is backed by real dollars in a bank account. Others might use riskier systems, and some have even collapsed in the past. So before you trust a stablecoin with your money, do a little digging. Make sure it's backed by something real and has strong audits. A stablecoin should protect your value, not add more risk. All right, let's talk about DAOs, short for Decentralized Autonomous Organizations. That sounds super technical, but stick with me. It's actually a cool concept. Think of a DAO like an online club that runs without a boss. No CEO, no manager. Instead, the people who hold the project's tokens get to vote on what happens. Want to change something in the project? Propose it, then everyone votes. Simple as that. The more tokens you hold, the more voting power you have. It's kind of like having more shares in a company. Now, DAOs aren't perfect. Sometimes people don't vote, or the system gets taken over by a few big holders. But overall, it's a powerful way to let communities control the future of a project together. All right, let's talk about something called yield farming, also known as liquidity mining. Sounds fancy, but here's what it really means. Imagine you've got some crypto sitting in your wallet. Instead of just holding it, you can put it to work by lending it out or adding it to special pools on DeFi apps. In return, you earn rewards, kind of like earning interest at a bank, but often with much higher returns. Now, yield farming takes that idea a step further. It's like trying to get the best rewards possible by moving your crypto from one platform to another. For example, you might earn a token on one platform, then take that token and use it on another platform to earn even more rewards. Some people keep repeating this process to try and maximize their gains. But here's the catch. It's not without risk. Prices can change fast, the platforms might have bugs, or the rewards might suddenly drop. So think of it like a high-speed game where you're chasing the best returns, but you need to know the rules before jumping in. All right, let's talk about multisig wallets. A multisig wallet requires more than one person to approve a transaction. Think of it like a shared safe that needs multiple keys to open. This is super useful for teams or any shared account where you don't trust one person with all the funds. For example, a 3 out of 5 multisig means any 3 out of 5 key holders must sign off before funds move. It dramatically reduces the risk of a single compromised key draining your assets. If you handle significant amounts or community funds, multisig should be in your security toolbox. Next up, bridges. As the crypto ecosystem grows, we've got multiple blockchains: Ethereum, Solana, Arbitrum, and more. Bridges let you move tokens between these networks. Let's say you have some ETH on Ethereum, but you want to use an app that only works on Solana. A bridge will let you lock your ETH on Ethereum and then create a version of it on Solana, so you can use it there. Bridges are essential for seamless multi-chain experiences, but have proven to be high-value targets for hackers. Many bridges have suffered hacks in 2024 and 2025, so always pick trusted ones, like the official Arbitrum bridge. Finally, let's wrap up with Layer 2 solutions. Ethereum is amazing, but it gets slow and expensive when everyone's using it. Layer 2s are separate chains built on top of Ethereum to process transactions faster and cheaper, then settle the results back on Ethereum mainnet. Popular names include Arbitrum and Optimism. They batch up dozens or hundreds of user transactions off-chain, reducing per transaction costs to cents instead of tens of dollars. If you're still paying high fees on Ethereum mainnet, it's time to bridge over to Layer 2 and start saving on every swap, send, or mint. Many wallets now support seamless Layer 2 integration, making it easier than ever. And that's it for today's video. If any of these were new to you, drop a comment below. Let me know which one you want me to dive into next. Stay curious, stay safe, and stay decentralized.